Hey guys, welcome back to the channel McNallie Money, the official home of power mining analysis. In today's episode, Anthony Power and I are joined by the CEO of Soluna Holdings, John Belizaire. We're going to be recapping fiscal year 2024, Q4 results, and of course, forward-looking outlook in 2025. We've got a lot to talk about. Before we get into it, take a second, smash the like button, guys. Big help to myself and the channel. If you're not already subscribed, McNallie Money, feel free to join and let us know in the comment section below what you thought about the Soluna Q4 results, if you're currently holding shares, and your outlook for the remainder of 2025. Now, with that being said, let's get into today's interview. Okay, guys, so that's right. Today's presentation, we've got John Belizaire. He's the CEO of Soluna Holdings, here to talk about their fiscal year 2024 and Q4 results, in addition to outlook for the remainder of 2025. John, thank you for making the time today. Looking forward to the discussion.
Thanks, Bryce. Nice to be back. And Anthony, nice to see you too.
Most definitely. A very timely interview. I know the earnings just came out here, John. So to kick things off, can you give us some of the high-level numbers, the highlights in terms of operational performance and the financials for last year?
Yeah, absolutely. The short and simple of it is that our core business performed very well in 2024. We had strong revenue growth. Revenue increased over 80%, and that was driven by full year operations for our Dorothy projects, our flagship project in Texas. Revenue reached $38 million. That's our highest in history, compared to $21 million the same year last year in 2023. So, you're talking about $16.9 million increase. Additionally, in 2024, our demand response service, the ancillary services side of our business, delivered over $2 million in revenue. And the other is, if you look at our gross profits on the core business, you'll look at excluding, let's say, the loss of $5.7 million on the Project Ada or cloud business. The annual gross profit grew to over $9.9 million, which was up from $5.7 million in the fiscal year 2023 to 15 million point one in fiscal year 2024. So that's driven by that full year of Dorothy and DRS. It's also driven by some things that we did differently in our operational approaches. Last year, we sat down and talked about how we can become, the best miner in the industry. And it's something we call relentless stewardship, as sort of the program name. And there's a whole series of things we did last year. And the financials show the effects of that. Our gross margin held consistent for 2024. The business demonstrated some really strong gross margin growth from the Bitcoin mining and hosting business and demand response. And that offset some of the losses from the Ada and cloud business, but the ultimate result is that gross margins held flat at 25%. And then on the adjusted EBITDA, that was also resilient in 2024. Adjusted EBITDA ended at just under $1 million, so $0.9 million, compared to 2023 loss of over $3.5 million. So that's an increase of $4.4 million, and that was driven by just the growth of the business. We were able to grow the business despite all of the sort of downward market pressure on price and volume from the Bitcoin halving and the early phases of the Project Ada or HPC business. And cash grew. Unrestricted cash grew 23% from the end of 2023, reaching just under $8 million. So I think overall, it's fair to say that our business is very strong. Our execution on the core business is very strong. And we continue to see growth opportunities in that area for 2025, which I'm sure we'll talk about today.
Yeah, we'll jump into Project Ada in a second here. I'll let Anthony
Mhm.
go into that, but I did want to mention, John, just on your core business there, Project Dorothy. I know you guys have a great slide in the presentation talking about this first year in operation. As you cited, this is really the core behind Soluna Holdings. Can you talk to us about what was really the driving factor within that Dorothy project's first year to get that impressive 80% revenue growth?
Thanks. Yeah, about a year ago, our management team sat down. We do this strategic offsite every quarter. And we asked ourselves, how can we become, now that we've got our projects fairly stable, Dorothy is live, we're expanding our pipeline. We asked ourselves, how can we become the best Bitcoin hosting provider in the industry? And from that meeting, we came up with a mantra we call relentless stewardship. I've made mention to it sometimes as we post some of the updates. Relentless stewardship is a multi-program focus around scaling our hosting capacity. So it focuses on scaling the capacity. So you're going to see that with D2 and then eventually Kadi. We made some technology investments to help improve the operations of those sites. And we also invested in a customer-oriented service delivery program and a number of other operational improvements, including proactive maintenance strategies on our infrastructure. And all of that was to deliver the best possible service to hyperscale miners. If you look at the mining industry, there is a big focus around scale. If you're large and scaled, you can get economies of scale on the acquisition of assets, manage the mining fleet. But as you deploy new and more advanced miners, what happens is you have this sort of large fleet of mining equipment that doesn't really get you much if you just sell it, which was something that was relatively helpful in the past. You have two choices. You can store that in storage for some time, or you can find highly efficient operations and hosting providers to deploy that to so that your exahash doesn't go down, it continues to go up. Well, we focused on filling that gap and providing these services to folks. And I can say that the team has executed well on that strategy. And we intend to continue to do that this year with D2 and then eventually Kadi. Now, when you put all that together and look at sort of what was happening in 2024, the significant year-over-year drivers from a financial perspective, when you double click, is essentially revenue increase from the full operations of these facilities, which tells you that we have designed facilities that are highly efficient, very scalable, and the structure and contracts we've put in there are very profitable. And that allows us to deliver consistent levels of availability and efficiency. This is also aided by some strong hash rate and pre-halving and during the pre-halving phase, and also some hash rate improvements over our expectations last year, and on average over the remainder of 2024. And finally, the full year deployment of the demand response program added an extra boost to revenue, $2.1 million. And that's a very profitable program because we're providing services to the grid with not a lot of cost associated with that because we use technology to manage that service. So the combination of a very conscious operational approach to target the largest miners and most successful miners in the space as customers and putting in good contracts, and then scaling the business and adding more revenue streams on the same infrastructure. And I'll come back to the importance of that piece is that, by essentially organically building power and infrastructure, that affords us a number of ways to monetize that infrastructure.
That's great. Just a quick question before you just raised there the demand response credits 2 million. Is that a benefit to Soluna alone, or is that shared with potential stakeholders?
Demand response is a separate revenue stream. We're able to deliver the demand response without disrupting the service delivery of our customers. And so the uptime that we promise to deliver to our customers already incorporates the downtime that would be related to demand response. So the behavior that we would be performing is already something that is embedded in the architecture of the sites. What we're doing is monetizing that behavior, and that monetization allows us to then invest in technology to improve the performance of those sites. And so we think that over time, as we scale that and continue to do that, that's going to certainly help on the bottom line.
And just a further question. So obviously, having spoke to some of the miners that are based in Texas, getting these response credits, you have to wait like a full year before you're entitled to start receiving them. As you scale, now that you are sort of like past that criteria, does it mean that every scaled growth automatically starts receiving management, or do you have to then apply a year to every new facility?
First of all, in the Soluna case, we don't implement our demand response as a credit program. I think some other miners get their power delivery front of the meter through service providers or REPs that then deploy their asset into the programs and then give them a credit off the price. This is a service. In our case, we register the asset directly ourselves with the grid operator and deliver the on-demand curtailment services. And so this is revenue for us. This isn't a credit against our power. Our power cost, and by the way, our power costs and average costs across our sites does not take into account the demand response. So we get those prices without any type of credits. And I think that's important to know. That's purely based on the architecture using curtailed energy and the way we structure our PPAs. So even if we didn't have demand response, we would still enjoy the $30 per megawatt hour or below power prices, whereas some of our peers get to the lower prices through the credits themselves.
Through the credits
so
themselves.
This is all gravy and incremental for us. And
that's what the shareholders want to hear, is gravy.
Exactly.
So
that's right.
No, I mean, and Bryce, you highlighted the 8% growth in revenue, the growth in gross margin. So your core business is doing very, very well, as expected. The challenge came with the update, with the announcement of the termination with the HPE contract, and I think that probably shocked quite a few people. And we'd want to just talk about this maybe from your perspective, but also maybe to put some thought into maybe other companies going down this route in the future, sort of at the sort of size, and maybe some of the sort of like understanding what can be the pitfalls of getting into this type of a service if you don't thoroughly carry out all the due diligence required.
Yeah. So I'd like to start by just speaking for ourselves, the work we did to make a decision to enter the space, how we structured the deal, taking into account that we know it would be a young company and we would be learning. There were two primary objectives in investing in that space. We needed to understand the requirements for AI. The only way to do that is to get into the business yourself and try to understand customer requirements and what a data center design would need to look like in the projects that we would want to place them. And so our strategy was to create a GPU as a service business. As you'll notice, we specifically created a smaller version of that relative to our peers. Most folks went in quite heavily into large GPU deployments, et cetera. We decided to do that to test the market, grow slowly. We did an analysis on the pricing of the GPU markets, and we made a very concerted decision to go in with an OEM provider that can deliver us the GPUs as a service, allowing us to ensure that we can deliver high quality services to customers that would deploy it, design it in a architecturally enterprise class way. And our expectation was to target enterprises and larger labs or emerging labs that were doing smaller LLM type projects that would fit within the 512 cluster that we signed with HPE. We saw a very robust market at the time that we signed it. And then we signed the agreement, re-raised capital at a lower company. And I want to talk a little bit about Soluna structure a bit here. That lower company was the contractor with HPE. And that's the company that went to market with the cloud or GPU rental service. And as we went into the market, we noticed a couple of things. Enterprise demand still has not reached the level that would warrant these sort of smaller work group type projects. That's still emerging. The second is that if you look at the entire space, the reason there is a GPU as a rental market is because somewhere in the middle between data center power, data center infrastructure, and OEM equipment, and customers and service providers is this new middle market that provides a host of different services for GPU rentals. And the reason was not everybody could deploy billions of dollars to go acquire GPUs like OpenAI, so GPU rentals became a big business. At the time, hyperscalers could not deliver that service, and so it created this sort of neo-cloud market, and CoreWeave has been the number one beneficiary there. There are others like Crusoe, NeoCloud, et cetera, who provide essentially a full stack service for GPU rental, and they go and rent space at data centers. You have had a number of new entrants that also joined the club. We were among those in 24. And then you have this marketplace and sort of demand aggregators, if you will, for that rental market. What we saw in the second half of 2024 at Ada Cloud is we were running into bidding processes where we can deploy our 512, but the pricing that was being offered to us was below the price we structured the HPE contract. And the HPE contract was structured as a fixed contract for the GPUs for a 3-year period. And what we saw essentially was the erosion in the pricing for GPUs. We think that's driven by the fact that a lot of H100s came into the market, probably because of all the crypto companies acquiring these assets and putting them into the market. 2, there was a slowdown in a wait for H200s and then later generation equipment. And so people were sort of saying, look, I can get a deployment of H100s, but I'm willing to pay X for it. And one more thing, most startups were getting funding to create the next OpenAI, and it was becoming clear that to do that, it would take so much capital and so much time. They started to shift to more shorter term training runs to see if they can get a fast win. And if they could, then they would double down on that. And so they were trying to stretch their cash as venture capital started to move away from the market. And that caused most of the capital to concentrate on the most successful companies, the OpenAIs, the Mistrals, the larger labs, who then went to the much larger neo clouds. So when we started seeing this, 2 decisions were made. One is we didn't sign long-term contracts at those low, unprofitable levels. And that's why in our Q3, Q4, you weren't seeing deals being closed because we were reluctant to sign deals that were unprofitable. Otherwise, in 2025, you would see a continued bleeding, if you will, of unprofitable business. We might have revenue in Ada Cloud, but it would be a drag on our financials. And that didn't make a lot of sense to us unless we were going to grow out of it. And to grow out of it, we would have to think about what would the price be in that next sort of run. And that's when we said, okay, let's take a step back. If this market is fairly fragmented, we're a smaller player, there's going to be a significant consolidation, we believe, probably in the next year or so in the market, and it will consolidate around the largest neo cloud players. Most of the capital will be deployed to them, and they will need power. They will need data center space, and that is becoming much harder to find these days. And so we asked ourselves, how can we differentiate in the GPU as a service, GPU rental business? Anthony and Bryce, you may not remember, but the last time I was on the show, I said we have two businesses. One is on the AI infrastructure space, where we build data centers or deploy powered land assets to data center development. And we have this GPU rental startup. We really have to decide which one of those is a real business for us. And it became clear to us that GPU rentals, the only way you can differentiate in the marketplace is if you can quickly scale that business to over $100 to $200 million, have a low cost of capital such that you can acquire this equipment and continue to scale it, and you have to be able to sign long-term bankable leases with data centers so you could deploy that equipment. And it became clear to us that we should be where we're good, and that is building infrastructure that can support those markets. And so that's why earlier this year we decided to, as Ada Cloud Co., the board at that company reviewed that analysis, and it became clear to us our best efforts and focus should be where we're good, and that is the development of projects, development of data centers, going vertical, and that's where we're going to focus on AI JVs going forward. And we decided to exit that contract. Does that make sense to you guys? I sort of went through a lot there.
But it makes sense. Obviously, from a share perspective, what they'll be wanting to know is what are the liabilities to Soluna for actually exiting that contract? What provisions have you sort of like put into the accounts? Whether they're going to be fully achieved or not. But
Right.
Obviously, there was a lot of chatter once the results came out, especially in a lot of the social media platforms. I'm part of one which has a significant amount of Soluna investors in that platform, and been following all the podcasts that we've been doing and interviews I've been doing with you, John, over the last sort of 18 months. So
Right.
From that perspective, if you can just explain what's the sort of like what the liabilities to the main company and the structure and how that works in brief terms, please.
Yeah, happy to do that. So if you look at the Soluna organizational structure, at the top of the tree is Soluna Holdings. That's the public company that trades on the Nasdaq. And that company owns a number of corporations underneath it. That's why the parent company is called Soluna Holdings. And then it has a number of operating companies underneath it. There are three primary ones as of today. The first is Soluna Energy. That's the company that develops the platform that identifies and acquires and sites for co-locating data centers with renewable energy power sites and to construct data center assets. That's called Soluna Energy. Then there's Soluna Digital. Soluna Digital is the Bitcoin hosting and Bitcoin mining business. That company works with Soluna Energy to deploy data center assets behind the meter. It builds and operates Bitcoin mines, it leases the space, and it's served power by the Soluna Energy business. And then you have Soluna Cloud. That was a newer company we formed last year, which is focused around those two businesses, the GPU rental and the AI infrastructure space, building out data centers for the market. We try our best to keep each of those companies fairly siloed. There are independent businesses that have, their own P&L, separate investors in some cases, right? We raise capital at project levels. So all of the Spring Lane investment, for example, is under Soluna Digital. Investments around development capital, et cetera, is in Soluna Energy. And in Soluna Cloud, that's where we had the AI business. And below that, you have Soluna Ada Cloud. So if you zoomed in on that part of the tree, you'll see there's a branch or a leaf below called Soluna Ada Cloud or Ada Cloud Co. And that's where we placed Project Ada. Project Ada was the HPE deal, which included the GPUs and a lease at a data center in Canada. And that contract lives down there. Soluna Holdings is not a party to that agreement. Soluna Cloud is a guarantor. Soluna Holdings is not. Soluna Cloud is involved in helping to operate the Soluna Ada business. Soluna Holdings is not. And so when you look at the termination actually happened at the Soluna Ada CloudCo company, and that's where all of the financial obligations, potential financial obligations going forward, lived. The contract was serviced through that. All of the business and agreements with customers are there, and that's the company that is being wound down and discontinuing that service. By way of example, for folks who have been investors with Soluna for some time, we had a data center in Kentucky called Project Marie. It was a data center co-located with a steel manufacturing facility. When we started to move the business over to hosting, we had to decommission a mining operation that was there. And there were customers and debt and NIDIG type relationships that all lived at that company. And that company was below the sort of Soluna Digital, if you will, branch. And most of obligations and other activities took place there. A similar situation is here where the HPE obligation will live at that company. And to the extent that there are ongoing financial obligations, they would live there, but there's not much there. There's really that contract, not a lot of resources or assets as we begin to decommission it. Now in the HPE contract, because it's a service and they have GPUs and they have other customers, when we terminate, HPE then has an obligation to go and try to mitigate those financial obligations because they can redeploy those GPUs that they continue to own to other contracts and sign other customers and so forth, which would allow them to fill any gaps that we would have left with that termination. I presume they're going through that, and we'll learn of any continued obligations. We did have a deposit down there. And so we expect that deposit to be part of how they meet those obligations. And so there are resources down there for them to engage with.
That's great. Now, we talked about Dorothy 1 a little bit earlier in the presentation, John. I wanted to get an update on Dorothy 2. This is obviously a major milestone. You talked about Bitcoin hosting as kind of one of the real opportunities you see moving forward, at least at scale. This is going to bring you up to 123 megawatts by Q4. So can you talk to us a little bit about this expansion and the positioning of Soluna with Dorothy 2 in the portfolio?
Yeah, absolutely. Dorothy, we're pretty excited about Dorothy 2. We're adding another 48 megawatts to our portfolio. So that takes us from 75 up to 123 megawatts of hosting capacity. We are executing on our Relentless Stewardship program, which is inviting customers who are current customers of ours to grow with us, and they'll be growing with us at Dorothy 2. We are also attracting newer customers. In fact, we've had a pretty significant increase in demand for our hosting services as the word is getting out that we're a great operator and provide white glove service, I like to say. And that demand is international. In fact, we have large mining companies that are outside the U.S. that are interested in our assets and in our hosting services. Dorothy 2 is the culmination of all the learnings from Dorothy 1. At Dorothy 1, we learned how challenging it is to get through a regulatory process, and so we accelerated that process with D2 by embedding that in the D1 process. We've learned how to work with our power partners and understand how best to plan with them, determine how and when new construction projects would take place so that we can plan the downtime on the substation, et cetera. We've also improved our supply chain management, ordering long lead equipment early so that we can hit our schedules. And we've also improved on the design of the data center to account for things that we learned on the thermodynamics that we've optimized, things that we've learned on dust management and other types of things like that, as you might imagine in those environments in Texas. And we also made improvements to operational readiness at those facilities so that one can manage these miners and customer equipments like they were our own in a much more efficient way. So D2 is going to benefit from all of that learning, and the construction process has proven so far to be benefiting from that. We're on schedule. We started the energization of the first phase of a three-phase deployment or three-phase ramp up. The first 18, 19 megawatts will be coming up in Q2, and we will continue to ramp that into the remainder of the year. And so that is very exciting for us. And as we have mentioned before, we have Project Kati. That is now shovel ready. We're going through the capital formation process, and it's very likely, knock on wood, that we will start the construction of Kati. And that will be the first time we have two projects under construction at the same time. And Kati would add potentially another 83 megawatts to the 120 megawatts of capacity. And that's very exciting for that business because it's a very scalable, profitable business. We're good at it, and we intend to grow it.
That's good. In terms of the last couple of quarters, you've managed to restructure some of the debt on the balance sheet, particularly the convertible notes, which we saw the updates for. Talk to us a bit about that, and also about what that gives to the company, and also about I believe you'll also mention on your updates about the preference shares in terms of how they can be converted into shares, and
Right.
how that actually works, in terms of just giving understanding to shareholders, please.
Sure. I'll start with the complexity reduction on our capitalization. One of the things I have been focused on as CEO since coming on board a couple of years ago was to work to reduce the complexity of our cap table. We had convertible notes, Pref A, Pref B, a lot of structured financing tranches, if you will, at the parent company level. At the time, it made sense to use those tools because we were a small listed company, and we needed to raise capital to build out and acquire miners and so forth. When I came on, I had sort of the aftermath of that, and I've been sort of working through with the team to do that. Now, when there are financing documents in place with things like variable components, repricing mechanisms, conversion rights, anti-dilution, et cetera, all sorts of participation rights, ROFRs, that makes it very difficult to bring in capital because you have to, again, continue to furtherly structure around that, or you may have folks just say no because there are risks associated with being side by side with these. By fully converting the convertible notes and restructuring the elements of the Series B preferred, that's the non-trading preferred share, about $5 million in investment that was made. We restructured that in the fall of last year, which allows it to eventually get simplified and convert into common, and also ways at some higher stock price. And we have other mechanisms as well. This all simplifies our cap table and makes future financing a lot easier to do, presumably or hopefully less expensive and less dilutive, giving our shareholders a better ability to project what that potential dilution might look like, et cetera. You asked about Series A, which is the other layer. That's a series of stock that we created as well with a 10% dividend. We have not declared a dividend or paid one in some time as it relates to that class of stock. It does accumulate, so you see it on our financials. Sometimes it can be confusing where it looks like we paid the 9.9 million, but it under the documents it needs to accumulate until we start paying it down, etc. We are always evaluating how to approach that particular series of stock. We could look at some sort of conversion of that. We haven't made any decisions on that. Whether there's a dividend payment, we're always weighing whether that should be focused on deploying capital into the growth of the business versus the available cash past those profits to paying dividends. That's something that the board decides on, and we will continue to evaluate what to do about Series A going forward. But as the business grows and we start to become more profitable, and essentially that profit drives our own steam, if you will, as a company, then we can explore some more expansive ways to do that. In our 10K, we have a clear explanation of what the conversion rights are and the conversion ratios for Series A might look like in a number of different scenarios. We encourage folks to go look at that. We've updated it recently because it became clear to us that there was some confusion about what those conversion levels might be. And so we've updated our filings to have that information. So taking a step back, we have a much cleaner cap table. We have a base business that is strong. We have a strategy to expand into the AI business, primarily on the infrastructure side, much like we did on the mining side, focusing on long value creating infrastructure that can then be leveraged with our partners to build vertical solutions that can drive revenue. That's going to be our focus, and we're going to need capital to do that. And we're going to raise that at both the project level, as we've done in the past, and we're going to raise that at the parent company level. And now, with this simpler cap table, it should be easier to do that.
I guess that's a good segue, John, to the next section here about capitalizing future projects. I know you've gone in with the partner level financing in the past. Does this HPC cancellation have any impact on your ability to do that moving forward? And at the parent level, what strategies will you use to capitalize in 2025?
Bryce, you're right. We have a host of ways we raise capital for our projects. And as a reminder, we raise capital at a project level. So each project, so Project Kadi, Project Dorothy 1A, 1B, et cetera, those are all standalone companies, if you will, or special purpose vehicles, they're called in the project finance parlance. What that means is that company has it's an operating company, and it can raise capital for itself. And there are a number of ways we do that. We bring in equity and or debt, or the combination of two, into those projects to finance them. The parent company, Soluna, can raise capital at the public level to inject and own portions of those projects. And we also design those capital stacks such that we get a percentage of the profits of those projects after the investors get a certain return. So in that model, that affords us a very flexible approach to use dilutive and non-dilutive capital to raise money for our projects. So Dorothy 2, as you recall, we raised over $30 million for that project, and that's how we continue to build out and execute there. For Kadi, we're doing capital formation, and we're looking at both equity and debt to finance that project. And then at the parent company level, our goal, once our stock begins to perform again, as people increase their confidence in our execution and understand that the core business is strong and we intend to continue to execute on growing it, and we put out catalysts, and we have a number that are on the way, that should drive momentum in our stock and allow us to raise a capital to help us get cash to invest in our portion of those projects that I talked about, where we have capital providers side by side with us. As we own more of the projects, we're able to garner more of the cash flows in the early phase of the project. And as the project exceeds a certain level of returns, then we enjoy even more of those profits. And that's the structure we intend on going forward. So if you look at Soluna from the top of the tree, if you will, the equity that we're raising is to develop the projects, buy equity in the projects, fund some of our ongoing cash obligations as an operating company and a public company. And then as the scale of our organization, so as we start to get, past Dorothy 2 into Cotty 1, we start to generate enough cash to actually, we're getting close to sort of, doing that on our own steam, if you will. And then more of the cash can then be injected to continue to grow the company, and you get this virtuous cycle, if you will, to help continue to grow the business. So I think the key thing to understand is, yes, the HPE program that was focused on GPU as a service, we made the right decision to move away from that because it was not a profitable business. It didn't feel like our other projects. And, as a management team, it's our job to make sure that we're focused on the right things that are going to grow the company, drive it to be successful. And that one was not. And so we made the decision to exit it. And for the way accounting works is they look at the contracts, they see what the obligations are, and they put that full obligation onto the P&L at the time that it occurred. So that's why you see a very large obligation occur on the ledger there. But going forward, what you won't see is us putting, unprofitable projects or GPU as a service deals into the P&L. And so you should see a very robust 2025 as we scale D2, start to ramp Cotty, et cetera, and you'll start to see the business scale. And then you're going to see some newer, more exciting AI-related catalysts that are more infrastructure focused, that look closer to our traditional projects that are very profitable and scalable.
Yeah, we're getting close to the end of the conversation, John. I've got a couple of questions I want to get in before the end. The first one is, it was great to meet some of the team last week at the conference, Man Disrupt, in Fort Lauderdale. The first day we were there was an announcement from Argo Blockchain and Gems, and it looks like Gems are doing a reverse takeover of Argo Blockchain, obviously because of the predicament Argo in there in terms of cash and in terms of the business, how that's been challenging for them since they failed on some of their debt in 2022, 2023. Have you been receiving calls from potential other mining companies to look at maybe some sort of a merger or acquisition? We talked about this in terms of the global space about a year ago as to whether some of the miners could get through. But are you having any of those conversations as maybe one of many options to consider?
Well, Anthony, of course, even if I was, I couldn't say. But I think that what's certainly clear is we're building a business that has real value. I get that that shareholders are concerned given the recent news, but if you really dig deeper, what you'll see is that we built a very strong business, a very scalable business. And we've learned over the last 6 months that the real business opportunities for us, as I said, are in the AI infrastructure space. And we intend to continue to push forward on that. That's why I say we absolutely keep pushing. And we believe that will build value. And to the extent that that raises lots of interesting conversations and strategic conversations, that's part of building a business that's worth a lot. And our strategy is to just focus on building that business.
Yeah, I mean, when we look at the last sort of 8 or 9 months and the share price, bear in mind the share price of many of the miners since January this year have probably dropped about 50%. But and it's notable your share price has come down quite significant. And again on this recent HPE news, which you've articulated in a way that shows highlights it's not as doom and gloom as maybe some of the shareholders were initially thinking when
Yeah.
the announcement was there. But in terms of where the share price is at the moment, and we know there are certain conditions for the Nasdaq as membership of there have to be maintained. Do you have a period where you have to? Obviously, you'll probably, if your share price remains where it is, you'll probably get notice. Do you have a period to rectify that before action's taken?
Yeah, there is a period that NASDAQ reviews before they give notice to companies to drive back to compliance. And with sort of the recent action on the stock, certainly that wears on us and we have to think about it. We haven't made any decisions on that yet. We haven't received notice from NASDAQ yet. We have a number of catalysts and news that we will be continuing to introduce. And we are hopeful that shareholders, again, take another look at the situation and realize that what they believe to be true is not true about our company, and that our company is actually in a very strong position. And to reiterate, we are a company that is a very strong development platform with over 2.6 gigawatts of power. And we have two branches that we can take to monetize that power. We have proven that one branch is extremely successful to date. We've taken it from a state where it was not clear how we would get out, quote unquote, of the situation we were in 2.5 years ago. And I think you can fairly say that we've proven that we can execute there, and we've built a very robust business. The next arm that we will be focusing on is the AI infrastructure arm. We learned a lot through the GPU as a service business. That's not a business for us. We want to focus on building data centers and leveraging our power to go do that. We have strong conviction that that approach will ultimately create stronger, more shareholder value. So if you are thinking about whether you should own the stock or not own the stock, that's a decision you have to make. But the facts are clear, and the data is there if you look closer, that this is a very strong business that has a lot of potential.
Yeah, I just want to finish on the fact that, we're talking about 2024 when we just finished the end of the first quarter of 2025. And if you
That's
look
right.
at the last quarter of 2024, when the Bitcoin price was averaging, I think it was like 83 or 84,000, that average revenue for the first quarter of 2025 will be slightly higher than that. And therefore, as you've increased your core activities, we hope
Correct.
to see probably a reasonably good update when you provide that later in maybe at the end of this month or middle of May, when normally companies report on their first quarter.
That's right.
Because you won't have any of the FESB nonsense where the valuation of Bitcoin is going to really show this time.
That's right.
About when you highlight those profits in one quarter, how good it is in the following quarter the Bitcoin price drops, and there's going to be some big losses for a few of the miners out there that when we see their Q1s, but it won't happen in as much in Soluna's interest because you don't have to benefit from the FASB rules either way. Yeah.
That's a good point, Anthony, and I love that your financial expertise is very handy here. So a couple of things you'll see going forward that we're scaling, so you're going to start to see Dorothy 2, right, ramp through the financials in 2025, and so that will certainly be a positive addition to our P&L. What you won't see is continued drag from the Ada Cloud Co business, because we made the strategic decision to decommission that business in 2024, and so that direct sort of P&L effect hits the business in that
Yeah.
calendar year, and you won't see it flowing through 2025. So you'll be able to see the business, the true business, a lot clearer, and then you'll start to see these catalysts that we put out, so you can start to see the vision and strategy going forward. So stay tuned on that. Again, I remain very confident and excited about our business, and I hope that shareholders will continue to feel the same.
Hey, John, as we listen to this, we were just in Fort Lauderdale at the Mining Disrupt conference. Anthony was on a panel with the Wall Street experts or analysts that cover this sector, and they continually brought up flexibility of management. And I know you've talked a lot about the management team talking through these strategic decisions. It appears you guys definitely have that flexibility. So I know we've covered a lot today. There's some ups, there's some downs out of this reporting period, but we appreciate you walking us through in more detail. We'll be sure to put those slides on the screen. If you guys have any more additional questions for John and the team, feel free to leave them in the comment section below. But I wanted to kick it back to you just for closing thoughts, John, and we appreciate the transparency.
Thank you, guys, and it's always a pleasure to be on this show. We touched on some things here that are important for shareholders to understand. And I want to reiterate the fact that our team and our management team are highly focused on continuing to grow off the strong base that we've built as a business. You can feel confident that we will, quote unquote, kill businesses that are not profitable so that we can focus our energy on the most successful parts of our business and implement strategies that we feel where we can fundamentally differentiate. In the AI space, our true differentiation, if you haven't gathered this yet, is our core pipeline. Power is a constraint for the growth of these industries. You look at any one of the big neoclouds, they're constantly rushing around looking for power and for new data center opportunities and either acquiring sites and so forth and looking to deploy new generation data centers. That means they've got to stand behind long interconnection queues, and it's going to take a long time. The beauty about Soluna is our approach allows you within a 12-month period to get a shovel-ready project that can be built for both Bitcoin and AI. And by combining those two methodologies or project constructs behind the meter, we can create a platform by which you can scale and build a very successful business going forward. So the beauty of it, the decision that we've made is a good decision to exit the rental business and focus on infrastructure, means we won't compete with our customers. They'll actually become great partners for us on the data center side. We won't compete with the other large neocloud customers or companies because they will become customers for us at our data center businesses, much like the hyperscale miners became our customers after we exited and didn't compete with them and became a strong service provider. Hyperscale companies are looking for ways to get more sustainable data center space. And one way to do that is to integrate data centers into renewable energy projects. You saw the deal with Google and Intersect Power. Well, apply that to the Soluna model. We have some of the largest infrastructure players as partners with us, allowing us to get access to sustainable energy for data centers. And in our book, when you talk about flexible management, the key phrase that we use here is laser focus. It's important at all times that we make sure we focus on the right things. We focus on the long-term vision and keep our heads down to execute. And that execution has been to focus on the things where we can differentiate and do really, really well. And that's the conversion of power to Bitcoin infrastructure and ultimately the conversion of power to AI infrastructure. So I want to thank you all who are continuing to hold an investment in our stock. And for those of you who have left, I encourage you to take another look because I think that you are missing an incredible opportunity.
Just to add to that, John, is also the fact that the experience you've gained in that project area in terms of developing those infrastructures, that will become more apparent when you deliver it on a scalable size, because it's not just like building Bitcoin mining data centers. There is a significant difference, different skill sets, and you've probably got some of those skill sets now to deliver it on a bigger scale in the future.
Absolutely, Anthony. There's another saying I have, and that is, pain is where all the learning happens. So through the experience we've had at the Ada project, we have learned so much about the AI business that we didn't know before. And frankly, that's the only way we could have learned is by getting into the business ourselves. And now we've learned a lot, and that knowledge will fuel our growth going forward.
Yeah, it's a great point. Appreciate the commentary there, John. Thank you again for your time. You guys feel free to subscribe, hit the like button. We'll see you back here tomorrow. Thank you.